Hey there and welcome to the channel. In today's video, I want to share with you some research that I'm doing on a small cap company from Australia called Jumbo, ticker symbol JIN. But the company is in the lottery retailing business, but they also are growing their software as a service business and managed services. But before we get into all of that, I want to show you the checklist that I use when I'm researching stocks. And I made some updates to the checklist. And I want to show you how you can get the checklist for yourself and use it in your investment research. And if you try it out and you see there's something missing on it, I would appreciate you commenting on the video and I can add it to the checklist. But for those of you who aren't interested in getting the checklist, I will leave a timestamp so you can skip this part. And what you can do, you can follow the link in the description or you can go directly to investing-toolbox.com. But the site is currently in the MVP state. So I'm just using it for a simple checklist right now and some calculators that I have on it. But my plan is to add a lot of investment resources to it to make it a better tool for analyzing stocks. So you go down here, you press checklist, you fill in your name and your email. You press checklist here. And this will take you to a locked version and make sure you're using the version 3.0, which is the latest version. What you have to do is you have to go to File and make a copy and just name it after the company you are researching. And if you make a copy here, you can edit the sheet. And if you look to the right side of the checklist, you can see the color codes that I use, where green is obviously something positive for the stock, and red is a red flag for the stock. Then you have blue, which is something neutral or it doesn't apply to the company. It could be something you're just checking off. For example, if you're going over the annual report, usually that's just neutral. You're checking that off. That's just to remind yourself to go over the annual reports. And as you can see here, you have the items that you have to go over here. And then you mark it green, red, or blue in this box right here. Then you have the comment box, and you especially want to put in a comment when there's a red flag. So if you're going over it later, if you are deciding whether or not to buy the stock, you really want to have the red flags explained because chances are you're not going to remember what the red flag was. And to the right of the comment box, you have explanation or example. And the example stock I use here is Meta, which is a company that most people know. And there are some explanation on some financial concepts if you are not sure what they mean. And it's good for you just to go over this before you start going through the checklist. And once I finish going over everything on the checklist, I can just go down here, press backspace, Control C, and it will count out the total green items, the number of red flags, and the number of neutral items, which is very good when you are reviewing this and deciding if you want to buy the company or not. So the ultimate goal of the checklist is to find a reason not to buy the company. And if we go through all the items and we can't find a reason not to buy the company, well, then we have to buy. So that's enough chatter about the checklist. Make sure to check that out if you are interested in using it for your own investment research. But like I said, the company does lottery retailing, which is currently 77% of revenue, and software as a service, which is 16% of revenue, and managed services, which is 7% of revenue. And the company's goal is to make the software as a services and managed services a bigger mix of the revenue, and they are putting more focus on growing that since the lottery retailing business is slowing down a bit. Now, I originally found the company in the Altafox Multibagger Study, and I would recommend checking that out. I will leave a link to the study in the description below. And this is a study from 2020, so this is not the latest information, but it is a really good starting point if you are interested in the company. So the company is enabling lotteries to sell online. And like Altafox says here, the company has best-in-class software and millions of customers already on the site. The company operates ozlotteries.com, and the two biggest Australian lotteries are estimated to have a 70% market share, but Jumbo has contracts with both the Tabcorp and Lottery West, and they are competing with the digital apps of the major lotteries, which are lotterywest.com and the lot.com. But like you can imagine, the barriers to entry for a lottery company are quite high. And you have to have these contracts with a major lottery. And like with all online gambling, it is highly regulated. So it's hard for new companies to get into the business. And also there are many companies that don't want to enter the lottery business because of the perceived negative PR. But the things that are a barrier to entry for other companies is also a risk for Jumbo, because they could of course lose a contract with a major lottery, and that is one of the reasons they are diversifying their revenue mix more towards SaaS and managed services. But managed services is something like a government or a charity that wants to set up their lottery. They can just go to Jumbo and they will do the work for them. And of course, regulations can be changed, and the lottery can become less popular with other online gambling like sports betting and live casino becoming more popular. But this is a good point from Alta folks here, where they say that the SaaS expansion strategy makes sense where there is a clear opportunity in the online lottery business, where only 7% of the world's lottery tickets are sold online. This has changed really rapidly, and according to the latest numbers that I read in the annual report of the company, it's closer to 30% right now. And of course, SaaS and managed services are directly related to the company's core business. Now, this is a question that I added in recently. What does FinTwit say? But I found out that some of the best investors are actually on FinTwit, and they're giving you a lot of high quality investing material. And for example, I found this on FinTwit, where this is from Michael Mauboussin, which is one of the best investment teachers of all time. And he published a paper called Understanding Competitive Advantage Through Market Power, where he's sharing a list of, well, it's actually a complete list of white moat businesses globally. And if we take a look at the list, you can see most of the best companies in the world, like Adobe, Amazon, Copart, FICO, Evolution. But I was really surprised to see that a small company which has only a market cap of around 570 million US dollars is Jumbo Interactive, which is the company we're looking at. And the FinChat.io mentions here that the company has had a 10-year return of 911%, and one of the KPIs for the company is total transaction value, which refers to the gross amount received for the sale of its lottery tickets. And we can see the 10-year growth from 109 up to 449 in just 10 years, which is pretty impressive. The first red flag that I marked for the company is something that I already touched on, which is their agreements with Tabcorp and Lottery West for their lottery retailing segment. And if something were to happen, if those companies don't want to renew their contracts with Jumbo, that could be pretty risky for the company. And that is the reason they are trying to pivot more towards SaaS and managed services. Now let's look at the financials for the company, and like I mentioned, they are a small cap company with a market cap of only 575 million, but they've had a pretty strong growth in their free cash flow, with their 1-year growth being 21%, 3-year 28%, and 5-year 17%. They are trading at a pretty attractive valuation in my opinion, with the EV to free cash flow being only 17 and price to free cash flow at 20. The company has a very strong return on invested capital at 37%, but is much lower than the 5-year median, which is 61%. But they've seen pressures on their margin due to troubles with their acquisitions. And you can see the same trend in the return on capital employed at 41% compared to the 5-year median of 45%, and the return on equity at 32 compared to the 5-year median of 33. But when I'm investing in a new company, I preferably want to have the return on invested capital and the return on capital employed at 20 plus. Now let's look at the margins for the company, but they have pretty juicy margins at 84%, but they've been going down a little bit for the last 5 years. And it is the same story with their operating margins, which are high at 39%, but have also been going down at the same rate. Their free cash flow margin is, however, more stable at 38 compared to the 5-year median of 36. The company has a very healthy balance sheet where they have no short-term or long-term debt and 50 million Australian dollars in cash. But with all of the acquisitions they've been making, they have been diluting shareholders a little bit for the last 5 years, which is obviously something we don't want to see. If the companies that we are invested in are making acquisitions, we prefer that they use cash. But just to defend the company a little bit, their multiple was crazy high a couple of years ago. I think their price to free cash flow went up to about 80. So maybe that was in the shareholders' interest to use their stock as currency when it was clearly overvalued. And finally, we have a pretty steady growth in their revenue, where their 1 year revenue growth is 13%, 3 year 18%, and 5 year 19%. Now, a quick look at the management team of the company, but Mike Weverka is the CEO and founder of the company, which is something that we like to see. And he has about 1% stake in the company. And we can also see that another member of the leadership team, Xavier Bergate, the Chief Technology Officer, has skin in the game with his ownership of 4.3 million Australian dollars. And if we check out the company at glassdoor.com, we can see that they have 47 reviews, which is not that much, but we have to take into account that the company is pretty small. But 61% would recommend the company to a friend. The company gets 3.6 stars out of 5, and the CEO has a 90% approval rating, which is excellent to see. Now, one of the things that I always check when I'm researching a company is if the company has any super investors invested. But seeing that Jumbo is only a $570 million market cap, it is very unlikely that the big guys are putting their money in it, since it's just too small for them. The next thing that I want to check is what is their earnings retention rate, and we are checking if they are just paying out everything that they have in dividends or using all of their cash to buy back shares. Ideally, we want to see some cash reinvested into the business to make it grow. We can see here that the company has 86 cents of free cash flow per share, and out of those 86 cents, they are paying out about half, or 44 cents, in dividends. That is a little bit too high in my opinion, but seeing that the company doesn't need much money reinvested to be able to grow, that is probably one of the best ways to give money back to shareholders, since we also don't want to see any value destroying acquisitions. But ideally, I would like to see more of the free cash flow reinvested into the business and retained by the company. Next up is the valuation of the company. And what I found out when I'm studying great investors, and as I learn more about investing, I'm seeing that a DCF analysis is really not what the best investors in the world are using. It is certainly the most common method to use on Wall Street, but the investors on Wall Street are not the investors that are my role models. So if we go back to my website, investing-toolbox.com, we could use the calculator there to do the Francois Rochon test. And Francois uses earnings per share, and I like to use free cash flow per share. And we saw earlier the free cash flow per share for Jumbo was in Australian dollars, but I've converted this to US dollars, which is easier for me to understand. So the company is currently generating 73 cents of free cash flow per share, and I think it's very reasonable to assume that the company will be able to grow it by 10% at least for the next 5 years, which means that the company will be generating $1.18 of free cash flow in 5 years. Now you can go to Morningstar and see what the median price to free cash flow for the company has been in the last 10 years. And I've already done that, and that is 24. And just a side note, the price to free cash flow has been much higher for the company. Like I mentioned, it was around 80 2 years ago. So I think 24 is pretty fair as a multiple. Now we've already calculated with a 10% growth, the free cash flow would be $1.18 times 24, which means that the stock price would be 28. So if we calculate the intrinsic value of the company at 28 in 5 years, we want to have the current stock price at 14 or lower, because we want to get a 15% return on our money. Now it just so happens that the stock price today is exactly $14. So I would say, at least in my opinion, the company is trading at a very fair price. We saw earlier that the free cash flow for the company, the growth for the 1, 3, and 5 years has been pretty strong, and the company is really in a good position to keep their growth going. Now, if we look at the overview, we can see that the total green items were 71. We had 11 red flags and 36 neutral items. So just to summarize this analysis, the company has a pretty understandable business model and a predictable business, in my opinion. The company has a moat in their barriers to entry, where they have long-term contract with the two biggest players in the business, and they are protected by regulations as well, which is also the riskiest part about the company, which is if they lose their contracts or they get a change in regulation. The management team seems to be high quality with skin in the game, and the company is trading at a rather fair price in my opinion. But of course, if you are interested in investing in the company, you should do your own due diligence and not listen to a guy on YouTube and all of that. As of this recording, I have no shares in the company, but after doing this analysis, I have to say I'm pretty bullish on Jumbo. But that's it for the video today. I do want to ask you to smash the like button and subscribe to the channel if you haven't already. I want to thank you for watching, and I will catch you on the next one.